News: New Ethereum Layer 2 Blast attracts $30 million hours after bridge goes live. Blast boasts prominent investors Paradigm and eGirl Capital members among others, but there's no way to withdraw funds until February. Investors have bridged over $30 million in Ether and stablecoins to Blast, the latest Ethereum Layer 2 network, just hours after the project went live late on Monday. The inflow is evidence of strong demand for Layer 2 networks or protocols that operate on top of a Layer 1 blockchain, such as Ethereum, to reduce bottlenecks related to speed, cost, and scalability. Bridges are blockchain-based tools that allow users to transfer tokens between different networks. Also driving the charm is Blast's unique design. Depositors start earning yields on the transferred Ether alongside Blast points. Blast natively participates in ETH staking, and the staking yield is passed back to the L2's users and dApps, the team said in a post Tuesday. We've redesigned the L2 from the ground up so that if you have 1 ETH in your wallet on Blast, over time, it grows to 1.04, 1.08, 1.12 ETH automatically. Users have to wait until the launch of the mainnet in February before they can withdraw any funds from the network or participate in on-chain activities. As such, Blast is invite-only as of Tuesday, requiring a code from invited users to gain access. Besides, the Blast points can be redeemed starting in May. Of the total funds bridged, data shows over $19 million in Ether has been staked on Lido, where it is set to earn as much as 4% annualized yield. Another $3 million is on Maker, while a smaller tranche of $150,000 in DAI stablecoins sits idle in the wallet. Users who bridge stablecoins receive Blast's auto-rebasing stablecoin, USDB. The yield for USDB comes from MakerDAO's on-chain T-bill protocol. Blast raised over $20 million in a round led by Paradigm and Standard Crypto and is headed by pseudonymous figurehead at Pacman Blur, one of the co-founders of NFT marketplace Blur. Tether deposits of $1 billion with UK financial firm are at center of High Court battle, FT. Tether deposited the funds with a subsidiary of investment bank Britannia Financial, according to the report, which cited filings made in the High Court. Stablecoin issuer Tether deposits of more than $1 billion with a financial services firm are at the center of a legal battle in London's High Court, the Financial Times reported on Tuesday. Tether deposited the funds with a subsidiary of investment bank Britannia Financial, according to the report, which cited filings made in the High Court. Britannia Financial is engaged in a legal dispute with British Virgin Islands registered Arbitral International, which alleges that Britannia failed to pay the full price for a Bahamas brokerage it bought from Arbitral in June 2021. Arbitral says it is entitled to extra money from assets generated by the business in the year following the sale, according to an agreement between the two firms. According to the report, Britannia claims that Tether deposited the funds with its subsidiary, Britannia Global Markets, and the transaction is therefore unrelated to the brokerage it bought from Arbitral. Tether's USDT is the world's largest stablecoin, providing crypto users with a hedge against the volatility that often besets cryptocurrencies. Tether's $86.4 billion worth of assets are mostly deposited in U.S. Treasuries. The assets also include $5.2 billion worth of secured loans. Tether did not immediately respond to CoinDesk's request for comment. Kraken accused by SEC of operating unregistered platform, improperly mixing customer funds. The U.S. crypto exchange is the latest targeted by the Securities and Exchange Commission in a series of similar actions being fought in court by other companies. Kraken has joined Coinbase and Binance as targets of Securities and Exchange Commission accusations that the companies are operating without properly registering as securities businesses in the U.S. The SEC highlighted a long list of tokens it considers securities that Kraken traded, each of which has now made multiple appearances in SEC enforcement actions. Crypto exchange Kraken commingled customer and corporate funds while operating as an unregistered broker, clearing agency, and dealer. The U.S. Securities and Exchange Commission alleged in a new lawsuit Monday. The federal regulator claimed that the San Francisco-based company violated federal securities laws in a repeat of its suits against other crypto trading platforms. Unique to Monday's lawsuit are claims that Kraken created a significant risk by commingling up to $33 billion in customer crypto with its own corporate assets, the regulator said. Quoting Kraken's independent auditor. Similarly, Kraken has held at times more than $5 billion worth of its customers' cash, and it also commingles some of its customers' cash with some of its own, the suit said. In fact, Kraken has at times paid operational expenses directly from bank accounts that hold customer cash. The SEC claims that Kraken simultaneously operates an unregistered broker, clearinghouse, and exchange echoes its complaints against Binance and Coinbase. Two exchanges the agency sued earlier this year. Those suits are continuing. The SEC previously settled similar allegations against Bitrex's now shuttered U.S. wing. The federal regulator, as it has with those previous suits, listed a number of tokens it deemed to be unregistered securities, including the Algorand token, Polygon's Matic and Near. According to the suit, Kraken took a direct role in promoting these tokens to the investing public. The SEC filing asks to permanently ban Kraken from operating as an unregistered exchange. The agency says it's also pursuing a fine and for Kraken to give back ill-gotten gains. We disagree with the SEC's complaint against Kraken, stand firm in our view that we do not list securities and plan to vigorously defend our position, Kraken said in a statement. The SEC has repeatedly challenged crypto exchanges to come in and register without a single law supporting their position and no clear path to registration. And despite opposition from lawmakers, the SEC continues to pursue legal action against these crypto exchanges. For years, we have advocated for effective U.S. market regulation that addresses the unique risks and benefits which crypto presents to all individuals. We believe congressional action is the most appropriate path to resolving the lack of regulatory clarity in the U.S. It is disappointing to see the SEC continue down its path of regulation by enforcement, which harms American consumers, stunts innovation and damages U.S. competitiveness globally. Bitcoin faces headwinds as ETF optimism stalls, Doge, SOL give back gains. Ether lost 0.5%, while Dogecoin and Solana slumped as much as 5% as traders likely took profits. Bitcoin prices were little changed in the past 24 hours while major tokens gave back gains from their early November rallies. BTC traded just over $37,500 in European morning hours Tuesday, adding 0.6%. Ether lost 0.5%, while Dogecoin and Solana slumped as much as 5% as traders likely took profits. BNB Chain's tokens were up as much as 8% amid reports that crypto exchange Binance, which initially issued the tokens, could soon be paying $4 billion to settle multiple U.S. criminal charges. Some traders expect Bitcoin to trade sideways in the coming weeks as its recent rally is running into headwinds caused by uncertainty about the Federal Reserve's next steps and due to delays in a key regulatory decision about ETFs. The upside has been suppressed at the $38,000 psychological level, analysts at the Japanese exchange BitBank led by Yukari Kusu shared in a Tuesday note. One of the reasons why Bitcoin failed to breach that level is the SEC's decision to postpone its decision to approve or disapprove Hastex's Bitcoin ETF on Thursday. Meanwhile, analysts at crypto exchange Bitfinex said in a Tuesday note that they expected the Fed to hold rates steady in the December meeting. Headline inflation has declined remarkably from 6.4% at the beginning of the year. This should give the Fed enough room to hold rates steady in its December meeting, in line with current expectations in the Fed futures market, the analysts shared. This would also align with its goal of sustaining economic expansion. However, this pause in rate hikes doesn't signal a change in the Fed's broader tightening policy. The central bank remains cautious and ready to adjust rates if inflation persists or unexpectedly increases, they added. Crypto miner Phoenix Group says UAE initial share sale was 33 times oversubscribed. Phoenix was looking to sell almost 18% of the company for a target raise of $368 million. Cryptocurrency miner Phoenix Group closed its initial public offering on the Abu Dhabi Securities Exchange, saying it was 33 times oversubscribed. The UAE-based company said last week it was offering 907,323,529 shares at 1.50 dirhams a share for a target raise of 1.36 billion dirhams, giving investors 17.64% of the company. Phoenix Group offers mining both through hosting services and a cloud-based service whereby clients rent hash rate. It also runs a crypto exchange called M2, powered by its native Ethereum-based token, MMX. The UAE is among the most advanced jurisdictions when it comes to providing regulatory clarity around digital assets. With Dubai and Abu Dhabi both touting frameworks that provide clear guidance on the treatment of different types of assets and which activities are permitted and prohibited. The legal clarity may give companies an advantage when courting investment. Retail investors oversubscribed 180 times and professional investors contributed to a 22-fold oversubscription, the company said. The shares are scheduled to start trading December 4. That's all, subscribe to the channel and see you soon.